Hello everyone and welcome. In this video we are going to run through the four main kinds of assets you can invest in. Plus, at the end of this video, we'll be sharing 3 top tips for investment beginners, so that you get off on the right foot. Let's get started. We're going to take a look at each of the main asset classes in turn. However, before we dive in, we need to understand an important concept in investing. When investing, there is a trade-off between risk and returns, which is central to building a good understanding of investing. The higher the expected return on an asset, the higher the risk is likely to be. Different assets have different risk levels, and different levels of average returns. Let's keep this in mind as we're learning about each kind of asset. 1. Cash. Cash investing refers to keeping your money in either interest-earning cash accounts held with financial institutions, like banks, or investing in short-term highly liquid assets, such as 3-month government bonds, which is referred to as money market investing. Some pros of cash investing are as follows. This is a lower risk asset class. With respect to UK savings accounts, most UK banks are part of the Financial Services Compensation Scheme, where deposits up to £80,000 are guaranteed. So, even if the bank was to go bust, you would not lose anything up to this amount. This asset class is highly liquid, meaning that, with the exception of notice deposit accounts and fixed-term deposit accounts, your money should be available quickly should you need it. You are protected from declines in other asset classes that can result from economic downturn. On the other hand, there are also some cons. Cash investing offers lower returns, reflecting lower risk. This is especially true when central banks, like the Bank of England or the Federal Reserve, have low base interest rates. Investing in cash exposes you to inflation risk. This means that if the price of goods and services increases at a higher rate than you earn interest, the purchasing power of your assets will decline, and you will become poorer in real terms. 2. Fixed income investing. Fixed income refers to debt investments. This can take the form of corporate bonds, government bonds, or other debt instruments. These kind of investments to companies or governments are basically large loans that have been split into a large number of smaller chunks. For example, Company A may want to borrow £1 million for its business activities, and it may do so by issuing 10,000 corporate bonds for £100 each. These bonds will be issued with a specific interest rate, say 5% annually. Periodically, interest will be paid to investors who own these bonds, which is called a coupon. In this case £5 per year, excluding any capital repayments. Bonds can be structured in many different ways, but we'll leave that for another time. There are several pros to fixed income investing. Returns are typically higher than that of cash investments. Coupon payments are typically non-discretionary, unlike dividends from companies, meaning bond issuers are obligated to pay it. Some investors see bonds as a defensive asset class, meaning in economic downturns the value of bonds can rise in value. Bonds are typically less risky and volatile than equity investments. On the other hand, there are some cons to fixed income investing. It is typically more risky than cash investing. You are exposed to interest rate risk and credit risk. The value of bonds can rise or fall as a result of changes in base interest rates, or as a result of changes in credit worthiness of the bond issue. In addition, unless the coupon rate is linked to inflation, you are also exposed to inflation risk. This kind of risk is most relevant for long maturity bonds. If the bond issuer cannot meet repayments, you will lose your investment. It's important to note that corporate bonds are generally more risky than government bonds, and have a higher return. Bonds with a longer maturity date will also generally have a higher interest rate, which also reflects higher risk. More generally, the risk and return associated with bonds can vary greatly depending on many factors. 3. Equities, otherwise known as stocks and shares. Stocks and shares allow you to own a portion of a company. Publicly traded companies allow members of the public to purchase their shares via a stock exchange. Owning shares gives you part ownership of residual cash flows generated by the company, after all creditors and all interest on debt has been paid. A return may be earned on shares in the form of capital growth and dividends received. Here are some of the pros of equity investing. Equity investing typically has higher rates of return than bond or cash investing. Shares give you voting rights over some company decisions. Share prices can benefit from growth in the economy. Owning shares can help avoid inflation risk, because the cash flows earned by companies can rise as general prices rise across the economy. On the other hand, equity investing is more risky than bond or cash investing, and you could lose your whole investment. Share prices can be highly volatile. Company management are not obligated to pay a dividend in any given year, even if the company earned a profit. And 4. Real estate. Real estate investment refers to investment in either completed property, or in property under construction. In this area a return is earned for the investor in the form of rental payments from tenants. This is in addition to potential capital growth, where the value of the property increases over time. This investment may relate to commercial property, where the property in question is used for commercial purposes, or to residential property. Investors can invest in real estate through either direct purchase, or indirectly through other products in the real estate sector. Examples of ways to invest in real estate indirectly include real estate investment trusts, shares in property companies, and property-related bonds, or loan notes. Some pros of real estate investment are as follows. Property is a physical asset which underpins its value. Income from property tends to be more stable than typical equity investments. Investment in property may also guard against inflation risk, as rental rates may rise with inflation. On the other hand, with direct investing, assets tend to be illiquid, meaning that they cannot be sold quickly. Moreover, direct investment in property requires active management of the relevant property. Investing a large portion of personal wealth in real estate can create concentration risk. Typically, real estate investment has higher transaction costs than other asset types. There are also further asset classes, such as commodities and derivatives, but these tend to be more advanced and won't be covered in this video. Okay, so we've covered each of the main asset classes. However, there is one other important point to mention. As an investor, assets can be purchased individually, however an alternative is to invest in an investment fund. This is where money from a group of investors is pooled in order to invest in assets with the aim of achieving a return for the investors. These can contain all kinds of asset classes. Benefits of fund investing include: it is easier to achieve diversification with a smaller amount of assets. It requires less close attention than investing in individual assets because, with active funds anyway, there is a fund manager monitoring the investments. Some disadvantages, however, are as follows. You have less control over assets invested in. Funds will charge a management fee for their services. As promised, we're now going to share 3 top tips for investment beginners. 1. Figure out how long you can invest for, and in particular what your investment goals are, and what your risk tolerance is. These 2 factors are most key when deciding what level of risk is acceptable for any investment. This is because you need to be personally comfortable with the level of risk you are accepting, and the longer you invest for, the more manageable these risks become. For example, if your primary savings goal is to purchase a house in a short time period, then investing in higher risk assets increases the risk that short-term price movements will impact your available savings. A bonus tip: you can split your total savings into different time horizons, and ring-fence your money for each specific goal. You will then be able to approach the risk in each segment as necessary. Tip number 2, start early, and benefit from the effect of compounding. Compounding refers to earning a return not only from your initial investment, but also on all previous returns that have accumulated. As this graph shows, the longer you have to invest, the larger the compounding effect will be. In addition, the longer you invest for, the more manageable riskier assets become. This in turn may allow you to benefit from riskier asset classes. And 3, diversify. Diversification refers to including a range of different investments in your portfolio. By having a wider range of sectors and asset types in your portfolio, the less risk you will bear relating to any one sector or asset type in particular. This reduces what is referred to as unsystematic risk, or specific risk, with the remainder of the risk relating to systematic risk, which cannot be mitigated in any given market or market segment. That's all for today, everyone. This video was brought to you by the Personal Finance Institute, where our mission is to bring financial literacy to you, so that you can plan your way to the financial future you want. If you are finding our content useful, informative, and you'd like to see more, please do like, share, and subscribe. If you have any questions about our content, please drop them in the comments section below and we'll do our best to answer them. Otherwise, thanks for watching and we'll see you next time.